really in the past 8 months have gone just crazy on real estate, because it's like I didn't realize how creative you could be, especially when you're talking about hard money, private money, like all these different things you can do, and it's just fun.
You're trading the discount for the now. So speed is, I think, ultra important, at least in some component of this real estate game.
It's expensive, so you're scared of it, but yeah, you're paying for speed, and people think, how do I get a proof of that or this or that? It's just scary. And I think if more people were made aware of like, it's actually not, it's actually very simple.
Poverty moves slow and wealth moves fast.
Traditional sucks, man. To me, it just slows everything, ruins everything.
You're not going to win. You might 1 out of 100. So therefore that problem is being solved by hard money in that scenario.
Yeah. Welcome everybody to another episode of the Real Estate AF podcast. Today we have a guest that I meet a lot of people, met on social media just randomly, and Michael Luculano. Did I get it right?
You did. That was good.
I got it right.
Yeah.
Right, cool, man. So yeah, dude, I guess to start, just tell us a little bit about yourself, what you do, when you got started, all that.
Yeah. So my name is Michael Luculano, and I'm here in Scottsdale. I've been here about 29 years from Florida. I am in the lending business. I got started kind of ironically because my buddies were making good money, and I thought, geez, if those guys are making that type of money, I'm at least to their level. And started in traditional lending in 2002. Timing was obviously very good at that point. So did traditional lending for about 7 years till about 2009. And then in 2009, discovered hard money, became really just obsessed with it, how it works, why it works, all the problems that I could solve based on that type of funding. Mm-hmm. Got, really involved, started doing a lot of deals, found the right investors, really just kind of went all in, right? And then have been doing that ever since for about 15 years. Pretty high level producer. Recently started our own fund, which is great. And through it, also have done some real estate deals because of the access to capital. So really just all things real estate and lending.
Gotcha. So you started in traditional, you still do traditional as well. What would you say the balance is right now between traditional and then like the hard money?
Right now it's probably 95% hard money. Yeah. With traditional lending, I don't really actively market for it. So it's one of those things that if somebody asks for it, or if there's a conversation where it makes sense, present it. But I've come to the realization you can't be good at everything if you're good at, you can't be good at anything if you're good at everything. Yeah. And so I really try to focus on private money and hard money stuff.
So why that as opposed to the traditional?
Traditional's a pain in the ass, man. Yeah. It's hard money is more expensive, but it's common sense. I mean, it's, the bank understanding why did you blink wrong and it showed up in your bank statement, and that's why we need a letter of explanation or why we can't do the loan. There's no common sense. Yeah. And I think there are some scenarios that require common sense. And I know that there are even deals that I've done that borrowers could have went to the bank, and they're literally so fed up with it that they will literally come and do hard money, even though they're paying more for the simplicity and lack of gray hair.
Yeah. Yeah. It's funny. I think he's dealing with that right now because he's going through a HELOC, and he's just every day it's something new. He's telling me they need this, they need that. And it's just stretched out forever. And I'm just like, this sucks, dude. And, as entrepreneurs, we're problem solvers. We like to find solutions and creative solutions. And that's kind of honestly why I really in the past 8 months have gone just crazy on real estate, because it's like I didn't realize how creative you could be, especially when you're talking about hard money, private money, like all these different things you can do. And it's just fun. We sit around and we've talked to, probably 20 different lenders and just trying to, how do we do this? How can we do this? Even sometimes educating them on stuff, especially when you're talking traditional, they're just like, wait, what?
It's a box.
It's crazy because it's like if those guys, which you figured out, if the traditional people understood how much more creative you could be to get deals done on the hard money side, it's like I would never do traditional lending again.
It just depends. It's like I have this saying. It says you can either wait for pricing or pay for speed. So in your case, you're waiting for pricing, right? Because the cost of the money is going to be cheaper than hard money. So you're waiting for pricing. Whereas, hard money is basically I'm paying for speed. But, I read this thing and I posted it. It said, poverty moves slow and wealth moves fast. right? Like decisive.
Yeah.
And all the deals you're doing, like, and I say this too, like you don't go get a deal, like unless you're paying retail, but if you go and get a deal, you get a good deal. Guess what? You're buying a property, you're buying a piece of land, whatever you're doing, the deal is in the speed. Hey, I'm going to go sell you my 500K house for 350 because I need to move or whatever I need to do. I'll give you a great deal. Go ahead and take your time. That's not how it works. Yeah. It's now, right? You're trading the discount for the now. So speed is, I think, ultra important, at least in some component of this real estate game.
Yeah, I agree. I think, especially to add some value to you, like what are some of on the hard money side, what are some of the like products and things you're pushing the most right now? And then also what I want to get into, and like I said, when we were talking over email, like I think hard money is especially just the average person out there, and even me 8 months ago, just like, what does that mean?
Right.
You hear it's expensive, so you're scared of it, but yeah, you're paying for speed, and people think, well, how do I get a proof of that or this or that? It's just scary. And I think if more people were made aware of like, it's actually not, it's actually very simple. They would probably do it and start getting into the game a little bit more. The people that are like, I want to do real estate, but I'm a little scared. I don't have much capital, or I don't have credit, whatever it is. And so, I mean, kind of break down hard money in layman's terms.
Yeah. So interestingly enough, it's really funny. I have this conversation with people a lot in the past couple of years, but I remember in 09, 10, when I was like really kind of getting going, hard money was like a 4-letter word, right? And I remember because I have like an Italian last name, no BS. I had a guy on the phone and we were talking about doing a loan, and he was like, okay, it sounds good, whatever. He was a little hesitant, and he asked, hey, what's your name? I gave him a name, Luculano. And he was like, oh no, because he had the Italian last name. And I'm like, this is lending, this isn't like lending on the street. Anyway, he didn't wind up doing a deal because he thought if he didn't pay, I'm like, you got to be kidding. I'll never forget.
That's where the mob, man.
I mean, I take the house is better than having to do anything else, right? It's not moving anywhere, right? But the reality is hard money is for a specific application. It's a guy who's buying a home to go live in it. You might do it as a bridge because you're competing with a cash offer. You might do it because your taxes aren't done and you need 6 months till they're done, right? But hard money it's not for the general audience. You're not like, hey, I want to go to the bank or I could go here. It's not really comparable, right? There's a problem that it's solving or there's a benefit that you're getting. And I generally put it under time, speed, property, or tax or income, right? You have an income problem, can't show income. You have a speed problem, you have a credit problem, or there's a property. You could be the perfect borrower, but the property's damaged or it's in shitty condition. The bank's not going to do it. There is no other reason or scenario other than those 4. So a guy who's doing a line of credit or something more traditional wouldn't really have a reason to do hard money unless there's like a hurdle as to why.
Sure.
A lot of I would say probably the number one thing that I'm doing right now is a lot of fix and flips, right? Again, they're getting a great deal because they're willing to take a discount, but they got to close quick. So unless the borrower is paying cash, which some do, then they would have to do hard money.
Yeah.
So it's the concept of price is what you pay, value is what you get, right? Hey man, I'm going to go pay 12% interest. Oh my God, so expensive. Yeah, but you bought the 500K house for 370 grand and you're going to make 72K on the flip. Yeah. Try getting that deal, telling the seller that you're going to take 30 days to close when they have 18 other offers behind them that are cash or hard money. You're not going to win. You might 1 out of 100. So therefore that problem is being solved by hard money in that scenario.
Yeah. Yeah. It's just crazy how much traditional just screws things up. Like I'm not out there just like wholesaling a lot of houses, but when a deal comes along, like I'll flip paper. I don't mind. I have one right now in Tucson. Like I already have an offer on it to be bought, but
as a wholesale?
Yeah, as a wholesale deal, but the buyer is traditional buyer.
Oh no.
So, and I haven't dealt with that. I've done a handful of wholesale deals, but it's always to an investor, hard money, whatever. So the traditional side, so they're coming back at me right away and they're like, we are not going to lend on an equitable contract. And I'm just like, what the hell are you talking about? So now I'm scrambling transactional lending. So now I got to buy it. So now I got to get a guy and give me 600 grand so I can buy it, and just so I can sell it again, which obviously fees and all that. Now it's like chopping away at my.
Are they unwilling to go hard money, your buyer?
They're not. They're already approved. They're ready to go. It came through a realtor. It's just super traditional.
Right. Very black and white.
Yeah. So I'm like, gosh, damn, dude. Now it's just gumming this up, making it last longer. And this deal, it's a foreclosure. It's supposed to go to auction the 24th. So it's like,
you're going to have to close on it.
Yeah, I got to move fast. So now, more hurdles, and it's just like traditional sucks, man. To me, it just slows everything, ruins everything.
Yeah, but think of it this way. It's actually a benefit, because if traditional can move quick, that guy could have just maybe bought it and you wouldn't have been there. So you get to solve what you have to deal with is the problem that you also get to solve.
True.
Does that make sense?
Yeah.
So.
Yeah. So what you said mostly right now, fix and flips. Are you just lending Arizona, or are you?
No, so we do a lot more than fix and flips. The reason I mentioned that to you is because that's typically the most common deal that I'm doing. We're doing a ton of cash out. We got a deal right now. It's crazy. We got this lady who's buying a house in Gilbert. She also has a house in Gilbert, so she's kind of downsizing. She has a ton of cash tied up in her house.
Right.
She wants to buy this other house, but they don't want contingent. They don't want to wait. So we're literally giving her a cross-collateral bridge loan from a second position on her existing home. So we're literally giving her one loan. It's like $1,350,000 secured by a second and a first of the new property in one loan, so that she can, it's like, I don't overcomplicate stuff, but this is kind of complicated loan. But basically we're collateralizing one loan against the new purchase, cross-collateralized with the second, so that she can go buy this home, not be contingent, and then she'll go and sell her home, essentially pay the loan off, and then we'll refinance the remaining balance of the hard money loan into traditional loan.
See, like what you said, I don't even know what the hell you just said. But that to me is problem solving.
Yes.
That to me is finding solutions for shit that you can't do with traditional. So
and having access to capital to be able to make, and understanding the financial market and how to structure that type of situation.
Yeah.
I guess the way I would say it, don't overcomplicate that, or wouldn't, is because it's all about cash or equity in hard money. Like, the house was worth 1.7 and she owes 550. So there's $1.1 million in there of collateral. There's $1.1 million in there of, skin in the game.
Yeah.
So we're essentially leveraging that to go buy the other one, and using the other one as collateral too.
Yeah.
So it's probably simpler to me, but it is kind of complicated. But yeah, we're solving her problem because she really wanted that house. Seller didn't want contingency, and we're getting it done.
Yeah.
So crazy stuff.
Are you on for your structure primarily on, let's say, the fix and flips or whatever else that you're doing? Are these investors coming to you saying, "Hey, I need money"? Or are you finding these flips? Are you guys doing that entire process from start to finish? Or are you more investor friendly, or are you more like looking for the deals yourselves?
So, I'm in the game. If I find a good deal, I'll buy it. But I guess speaking specifically from the hard money lending standpoint, I guess it would be clients that are coming to me, "Hey, Michael, I'm under contract, or I'm thinking about buying this. What do the terms look like? I can get it for this. I think it needs this. I could sell it for that." And then just trying to get a gauge of what they're doing. It's really just numbers.
Are you underwriting every deal?
I'm not, but I am. There's not a lot to underwrite. It's largely equity and asset based, right? Like, we're not typically looking at credit.
But but you're determining ARV, right?
In a flip deal, yes. But in that example I gave you, where we're using the second and the first, that was already established. That was an already built home where we were using the equity that was already there as additional leverage to cross and buy the other property. So that wasn't a flip deal. That was just a lady who was buying this home, wanting to use the equity here, so that she didn't miss out and having to make a contingent offer, which she wouldn't have gotten accepted. Does that make sense? Kind of?
Yeah, I know. I follow the logic there. Yeah. I'm not an expert by any means. Getting there, it takes time. Right?
Yeah.
But I understand the structure. I think of how you
basically it's cash or equity. If it's equity in your home, right? You're getting an equity line because you have equity in your home, right? So equity or cash, like, that's really what drives us, because ultimately when there's equity and then there's lendable equity. So for example, we don't lend to 90% unless it's a steal of a deal and there's huge upside. But if it's already a home that's there's no more upside, because that's what it's worth, right? Like, that home, there couldn't have been anything else to fix up, and that wasn't what she wanted to do. So the point of what I'm saying is that it's cash or equity. So she happened to have equity and not cash. So we use the equity instead of the cash to be
get it. Use that spread of what she owed versus what it's worth, and said, we'll loan against that to give you money for this property. And then as soon as you buy this property, since you wanted to make it non-contingent, you buy that property, and then she can just sell that one, and then boom, all the loans are paid off.
That's exactly right.
Yeah, that makes sense.
Yep. Yeah. So it's, what was the other question that you asked though prior?
Well, I'm referring to like how you guys are working deals within your portfolio. Like, for example, if I'm an investor, right? We find a property and say, hey, I think this is a slam dunk. We bring it to you. Is that your business model, or is it you guys are looking for them? But I guess you kind of answered that, and that you have.
I mean, I think anybody who's in the real estate or lending space should always keep their eyes out for deals, unless they're just against it. I mean, if you're in the space, if you have the education,
why not?
Why not, right?
Yeah.
I mean, in my opinion, the deal is more important than the money, because the money has to keep moving. So if you're in a space, a position, or in a scenario where you found a deal, you should know and want to actually do that deal. But to answer your question, so yes, I am looking at deals that I would flip or keep for my own self. But if somebody's calling me saying, hey, I've got a deal, within 1 minute, I know at least up to 80% chance if it's a deal. Because there will be people that call me and say, hi, I found this deal. I want 100% financing. We're a lender. We're not a partner, right? So there's a couple 6 questions I can ask to know like where we're going. You know what I mean?
So there's a couple lenders that we've talked to that do, anywhere from 75 to up to 92.5%. We've seen LTV on the fix and flip loans.
Correct.
You guys offer the fix and flip loan products?
We do. And understand that deal that you just mentioned, this way high leverage, the challenge is a lot of people just assume that's on any deal. That's because you're getting a great deal. And so another thing I try to tell people, there's a lot of people say, hey, in real estate, you don't need money, you don't need credit. Sure. But you can't have no money, no credit, and a shit deal. Like, it's still, you know what I mean? You got to have something.
So how are you as the lender? Because as we're talking to lenders, it seems that they play a big role in making sure that the deal is a good deal.
You have to. That's your whole collateral.
That's your whole collateral, right?
Yeah.
So how are you determining when something is a good deal? If we said we had a property that we feel is a good deal, right? How are you determining if it's a good deal?
So we're going to look at comps naturally, assuming it's a home that has comps. If it's custom, obviously you may have to do a little bit more work, but comps, I'm going to look at likely borrowers somewhat experienced too. If it's a $3 million deal, I'm going to look at it a lot more than a $400K deal, right? What does it need? If it's, hey, I'm getting a really, really good deal, it doesn't need a lot of work, cool. That's great for us, because if you get hit by a bus and we get stuck with the property, we don't have to do a whole lot of work. So the amount of work it needs is relevant. The loan to value, the purchase price, and the comps. Also, price point, right? Price point is going to dictate a $3 million home might sit longer than a $500K home.
Right.
So generally speaking, those are going to be the things that we're going to look at. Also, if you say, hey, I'm buying this house for $3 million, but the biggest deal you've ever done was $500K, we might question that a little bit. We might.
So you'll take experience into account.
I at least want to know about it. It's hard money is always something that each deal stands on its own. But yeah, when we start getting up, I want to kind of know that somebody knows what they're doing, or that, it's a $400,000 remodel is a lot different than changing out some carpet and paint.
Right.
You know what I mean? So we'll look at those. I would say those things are going to be a good chunk of what we would look at on almost every deal at minimum.
Now, when you say the comps, are you referring to recently sold or current listings?
Both.
Looking at both.
Both. If you're looking at, actives are your competition, right? Solds are what it sold for, but actives are which way it's going, right? So if you bought this home, you're like, hey, that one sold for, $500,000, but now the comparable one's listed for $450,000, you might want to think about that. You might want to think twice about buying that deal. That was kind of what happened, right? Like in 2002 or 22, right? When we kind of hit this top before the rates went up. Hey man, it's sold for this. Oh, well, that's weird, because there's, 18 more of them for sale right now. Which way you think we're going, So yeah, actives for sure as well.
So really, as an investor, we're looking to understand the lending parameters, right? So, and I think that's, as you learn and you become more educated in this space, because you've been doing this how long?
22 years.
That's a long time.
Yeah.
Right. Like, ask me about door-to-door sales. I got you. You know what I'm saying? But real estate is a whole nother world, and trying to learn that stuff seems daunting. I'm sure for you it's very easy, right?
Sure.
For people that are getting started in this, to start their real estate pathway, where would you start?
Look at deals. Perfection is the enemy of profit. And so if you think you're going to know everything, you're already lost, right? I think deals are the most important part. Financing is part of it, but I think you have to know what a good deal is before financing, in my opinion. And maybe that's just because I come from a financing background, but if there is no deal, the financing doesn't matter. So I think you've got to look at deals. I think you've got to understand just like the whole cost analysis. I want to buy this deal. Well, guess what? It's not just buying the house, putting the money in and selling it. The holding costs and everything else. And are you paying landscaping while you're waiting? I think one of the best things people should do, and certainly if I took, is they need to find a mentor. That's ultimately what they should do. Education is the shortcut. So I think that they need to get some experience maybe by somebody who's already doing it. That's probably one of the best things I would say.
JV with someone.
JV.
I feel like a lot of people are moving away from, I have a couple topics actually I wanted to talk about, but it seems to me on this subject, people are moving away from flips because the declining prices.
I mean, the market's got a price for anything, right? So if the market's going down, then guess what you should be doing as your offer? If that seller is out of their mind on what it's worth based on the market, move on. Not every deal or conversation you have with the seller is going to go well. I mean, there's the concept of right now, buyers think it's 2008 and sellers think it's 2021. So they're far apart, right?
Right.
Don't force a deal, right? Why would you go away from flips? Because the market's down. Just get the right deal. People are still buying houses, right? So, oh my God, we're not in the droves of buyers. Okay. It's either going to be harder to sell and easier to buy, or easier to sell but harder to buy. There's no like straight line of I'm going to steal this every house and magically crush it on every deal. Like you got to work to get those deals. So my reply to you is it doesn't matter what the market's going down because there's a strike price for everything. People still have to buy homes. They still have to park cash or whatever it is that they're doing. Just buy the right deal in that market. You follow what I'm saying?
Yeah, it's hard to, maybe you can look at something pretty quickly and tell if it's a deal or not, right? But for the average person, and I'd consider myself probably the average person to a degree. I'm probably not an idiot, but I'm definitely not super educated in real estate and the comps and stuff like that and what's going on. Obviously, you can do some research, but to see a deal and to go, I need it at this price for this to work. That's not an easy thing to figure out.
That's why it's discipline. And that's why a lot of people get screwed because they force deals because they're now gamblers. They're not investors. They're not disciplined. So you're 100% correct. There is no debate to that, but that's the game. The game is about finding the right deal, not forcing the deal and hoping it works. You follow what I'm saying?
Yeah.
So
where are you, for your own personal investments in real estate, where are you targeting? What areas?
I like Arizona because I live here. I would say, at least at this point, it's one of the most landlord-friendly states as of now. But I really like Arizona. We've looked at other deals, haven't really pulled the trigger on anything yet, but Arizona.
But in terms of what? Like, because it's a lot harder in Arizona right now to get something to cash flow. So are you talking about fix and flip or are you talking about buy and hold?
Anything, whatever it may be. I like Arizona. I kind of like being able to see it, touch it, feel it. Again, we've looked at other deals that we were close on in Florida and Texas. Didn't pan out, but I would buy something in another state. We had one yesterday I looked at in California, which scares the shit out of me for obvious reasons. Right. I stay disciplined. I don't force a deal.
But I mean, are you seeing in Arizona right now, like deals that are out there that'll cash flow?
Yeah. I mean, I don't think you can expect it to come to you. I mean, you have properties, right? How are you getting your deals? You're putting words out, you're writing posts, you're doing podcasts and stuff. You're letting people know. If you think, hey, I'm going to go into real estate, magically it's just going to fall because I called one realtor or I read a sign on the side of the road and I called him. Oh my God, the guy doesn't want to sell me the price. It's effort. So, absolutely. Yeah. So, I mean, I'm in the space. I've been doing this for 22 years. So I will have clients call me that found a deal, but don't have the money, found a deal, don't have enough money. And, you know, I think a good partnership is where one person has this and then you have that. Mm-hmm. So there's plenty of deals we do where it's with clients and stuff like that. So
what is the target? So we're looking at a lot of DSR stuff and it seems as though there's a price point where that makes sense.
Which
DSCR type loans, you know,
where
there's a price point where that works, and then there's a price point where it doesn't exist anymore.
Arizona's a tough state for cash flow. Like DSCRs are, I mean, look, you can do DSCR for any reason that fits the mold, but I feel like more of the Midwest is really good for cash flow, right? They're $200,000 houses, right. 210 next year. So the cash flow can support it. But if you have this up and down, you ever notice every time there's a real estate boom or real estate crash, Arizona's always in the top one to have appreciated or one of the top ones to fall. It's always that, right? Because we're we're a growth market. I mean, if you go to Wisconsin, I mean, are there a lot of companies and businesses and stuff going to Wisconsin? It's not a growth market.
Well, that's why we're looking a lot at the Midwest.
Sure.
For that price point and to make it cash flow quick.
Yeah.
And get, as many as, like, rack them up.
Yeah.
Especially on Section 8. I'm sure that you're seeing that as like.
Yeah, that's what we were just talking about. Yeah.
Yeah. So that seems like a cool model. Obviously, you have to have a lot of them because, one bad roof. I was watching one guy, he's like, a roof went out and cut the whole damn year's cash flow.
Yeah.
So I mean, I get that. You got to spread that risk through a crap ton of them.
Yeah, but that's always I always find that statement so interesting because it's like, hey, I got to have one roof went out, so all the cash flow went out because they didn't have enough properties. Okay. But what if you had 30 properties? Isn't there 29 more possibilities of 29 more roofs going out?
For sure.
So doesn't that kind of you know what I mean?
Again, I'm not, I understand the model. Like, there's guys that are killing it with that Section 8 program, right? They have, 100 properties or whatever. And then that guaranteed rent, paying 30%, the tenant is only responsible for 30% of them. Like, it's a model that makes sense because they don't have to worry about that cash flow problem because the government's paying for it. So I understand the model. I don't know. We're not deep enough into it to know how effective that is.
Sure.
But once you get over 250,000, there's no more cash flow at 7, 8, 9, 10% interest. It just doesn't happen. So is everybody flipping? Are people like?
I mean, look, I think there's a lot of, there's some other components, right? There's the speculation that, hey, if I just get it now, who cares? Because if interest rates go down, if I can make a little bit of money at 8% and then the rates go down and I can get 4.5 or whatever it may be, then I can make money then. Or if I buy it now in front of the rate, which I do agree with. If I buy it now in front of super low rates, I'm in front of the appreciation. So there's a lot of theories. That's a big one, right? A lot of people, myself included, believe rates are going to come down.
They have to, or else it'll get very bad.
Yeah. So truthfully, if that's one, right? So if I can function at 7% or whatever, 7.5%, well, if we go to 5, well, then I'm doing okay, right? So I think there's a little bit of speculation on certain things, which I think you're always going to have, unless you're just buying a great deal, right? So it's either like risk or just get a great deal.
So let's talk about what is a great deal, because is that a percentage? Obviously, it's all numbers, right? So are you looking for a percentage from purchase price to ARV? Is that the great deal? Is that what you mean?
The greatest deal is the one that you can get for nothing, right? The greatest deal is always lower. I would tell you that let's say a property had a 500K ARV and it needed 50K. I would like to buy that for probably 320, like no more than maybe 320, something like that. Because then you're in at 370, you account for holding cost. Also, I think price point has a lot to do with it too, because what if you bought a $4 million home for $3 million and you have to put 200 grand in? Seemingly, that's a really good deal, right? So you're in it for 3.2. But if you're doing hard money, your payment's 20 grand a month or whatever it is, it's going to sit longer. So I think the deal size has a lot to do with it too, because you might be sitting on it longer and your holding costs accruing. So hypothetically, again, 500K deal, 50K rehab, I want to buy it for 320.
That puts a lot more in perspective, because that's really what you're targeting, especially if you're trying to come in and it's a big risk to come in and do flips and all this kind of stuff. You can lose. I know people that have lost everything trying to figure this stuff out and not make the right decision.
I've literally had people call me for hard money, for financing, for deals that they would buy. And I said, okay, for example, what would you buy? If we're in contract for 300, I got to put 40 in and then I could sell it for 380. And I'm like, did you forget about some of the costs? And they literally either didn't forget or forgot. But when I asked them what they would make, they told me they would make 10K. So regardless of if they forgot or not, they were okay in their mind doing a deal to make 10K.
Yeah, that's one screw up. One, oops, the roof needs to be redone. You're squashed.
So people are forcing deals, and that's probably the hardest part, because it's kind of the concept of, a seller going, hey, who's the next biggest idiot? Like, don't be the biggest idiot. You know what I mean?
Right.
Let it go. It has a lot to do with marketing. I mean, I say this even to people in lending. I'm like, look, you guys want to make a ton of money? You need to be the best marketer. It's not the best salesperson that makes the most money. It's the best marketer. Leads and opportunities. I'd rather be shitty with a ton of leads than great with less, because I can improve my sales set, but I can't sell what I don't have an opportunity to talk to. So to answer your question about how do you get deals, get leads, market, or cold call, however you're going after it. The marketing is the most important thing.
Yeah, marketing trumps sales, always.
Every time. But people are afraid to spend money, or they spend money and the first round of marketing doesn't yield a lead, so it doesn't work, and this is all bad, and they quit. You know what I mean?
Yeah.
Which is good for us, more for us.
Yeah, there you go.
So I'm assuming you have a team?
I do. Yeah.
How many people?
what do we have? 5?
5 people on the team. And what is everyone doing? What's kind of the...
So I have an assistant. I have business development manager, 2 salespeople, and then me.
What are the salespeople selling?
Hard money. They're selling loans.
Got it.
Yeah.
They're selling the loans.
Yeah.
So are these LOs?
Yeah. Mm-hmm.
Basically LOs. And are you then a broker or is it?
Our brokerage is a broker. So yeah. Mm-hmm.
Gotcha. And then you guys have your own fund.
We also have our own fund. Yeah. So we have multiple sources of capital, one of which would also be our own hard money fund.
Okay. So what do you look for if someone wanted to contact you about a deal? What is it you're looking for?
In the deal, like we're looking to place money, right? So we have money, we want to put it out, secure it by collateral, and get a return. So I want to make sure somebody's got skin in the game. There's a reason for it, right? There's a problem we're solving. Again, it comes to those speed, income issue, property issue, or credit. That's generally where it falls under. And that there's some sort of problem or benefit that we're giving them. And that they have, the biggest thing is that they have money in the deal, whether it's cash or equity.
What kind of default rates are in hard money?
Believe it or not, it's not. We have a lot of people that will routinely be late.
Sure.
My payment's due on the 5th. I paid on the 19th every month, the 19th, right? Or rarely do we have default, like actual foreclosure default. The reason why is because if I lent you $350K on a $500K house, you have $150K to lose.
Yeah.
We're not doing FHA 3% down. I have nothing to lose loans. Like you got skin in the game.
Yeah.
Like you're in the deal with us.
Right, but you're a 20% deal, right? So you're wanting all of the investors to throw in at least 20% into that deal.
If somebody, I mean, look, we did a deal a couple weeks ago. The mother, it was $600,000 home. She was selling the home to her daughter for $200K. We give her 100%. I mean, literally, if the deal makes sense, I generally want to see money in the deal, but unless it's just the deal of the century, which that one was, and we do get deals like that on occasion, I want to know that somebody's got something to lose. See, I feel like that was a mother and a daughter. They're not going to lose the home. And if they do, we're covered. They're not going to lose the home. Yeah, you know what I mean? So it's...
You almost want them to lose the home on that deal.
I mean, not really.
Not really, but you know what I mean.
Yeah. But like, just think, hey, do I think this person is going to be covered? Like, if they miss a payment, am I covered? Yes. Would they have a reason to miss the payment? Do they have anything to lose? If they woke up one day and just decided, I'm done, are they incentivized or not incentivized to walk away? And that's kind of the general premise.
Do you cover 100% of the rehab costs?
We can for the right deal. Yeah. We generally like to be total loan, meaning at closing plus whatever the rehab would be, not to exceed 70% of the after repaired value combined.
That makes sense. I've seen that.
Yeah.
And it's just understanding the math.
Well, right. Because in that formula, we're protected now at the closing, we're protected along the way, and we're protected when it's completed. Like, people have to understand that we're literally, I say this all the time, we're lenders, not partners. I'm not taking a risk. I'm just not doing it. I'm not part of your deal. I'm a lender. I want to put the money out, get a return, go hang out wherever I'm going to go hang out. I'm not interested in risk because I'm not part of your upside. Why would I take a risk?
Yeah.
Somebody wants to make all the money on the deal. They don't want us to partake in it. Then make it no risk so you can have all the profit. That's how it works. That's how it works in any other business, right?
What kind of non-traditional like line of credit deals are out there? Or
you mean like equity lines and such?
Yeah, that are non-traditional, like the pain he's going through right now. What kind of non-traditional stuff is there?
There's some. The thing is that you're going through is not. I don't think there's a way to avoid it because you're getting a line of credit or
this is a HELOC.
Okay, so line of credit, like from a private money standpoint, I would never want to do a line of credit. I mean, even though like some of our cash out reimbursements are technically line of credit because they're putting the money up and then getting reimbursed, we know they're going to take it. You see, if you have a line of credit, it's a couple $100,000, whatever it is, it's there for you to take it if and when you want it. But I have to make it available. So it's kind of like, hey, I'll wait for you, even though I want to go put my money out and make money. That's a bank thing. It's totally a bank thing. So from a non-traditional route, there may be non-traditional way to qualify. But as far as I can see, and as far as I would lend on the private side, I wouldn't want to do a line of credit for the reason I just mentioned. Does that make sense?
When you're lending private money, and let's say the interest rate's 12%, 13%, whatever it is that about where?
Yeah.
Somewhere in that.
Yeah.
That's amortized over a year. It's
not amortized, generally interest only.
Right, but the payments are based on that interest only for, let's say if you have it out for 3 months. It's a 3-month flip.
Yeah.
Okay. You're going to pay in, if it's, let's say it's $100,000, you're going to pay in $3,000 in interest.
Right.
3,500 for somewhere in that. That seems like a very high risk. Almost the fees are more than the interest payments.
That's why hard money is generally fee driven. I want to go have to do a loan for somebody that because why would you want to keep hard money, right? It's expensive. You're not going to keep it forever. So the goal is, if you borrow money from me, the day you close, your goal is to pay me off as soon as possible. That's not the case with a bank, right? Like, I got a loan, I'm going to keep it forever. So the reason we charge the fees, especially on flips, is to ensure that we made money for the time and the effort we put in. If you go and you buy a property, you flip it in 6 weeks or even a couple months, especially if it's a small loan, we're not making a ton of money. Therefore, the fees and the points. And furthermore, there's a lot of deals that will, again, speed, right? Hey, I'm buying that house. I need to close tomorrow. Okay, well, I got to operate with the same urgency. I'm going to operate with the same urgency and not charge a fee to not make money. Also, you're going to pay me off as soon as possible? No way.
So really, those fees are that's part of the loan. That's part of the interest rate.
Yeah, we're definitely for profit.
Understand.
We were talking about fix and flips specifically in Arizona. Are you seeing the amount of investors for fix and flip going up right now? Flatline? Where are you seeing that right now?
I mean, if I had to pick one of those, I would say best flatline and likely down. And the only reason I say that is because, again, from 2020, 21, 22, I don't think you could have done a flip and screwed it up. Like, you literally couldn't, because whatever you bought it for, there was somebody right behind you willing to pay more. Yep. Which is really interesting because I see a lot of people, who I think is really impressive is when people call me and they're like, yeah, I did, 72 flips in 2008. I did X amount in 2023 and 24. That's impressive because to me, that's like a real flip. You got a good deal, but to buy a flip where you got like an okay deal in a super hot market, how much of that was your skill versus your timing? Does that make sense?
Where are you seeing within those fix and flip loans, like price range wise? Like, what's the highest price?
I feel like it's going up, and I love it because I love dealing with the larger dollar sizes. There's generally like way more margin, right? Because I think there's enough people who are, hey, if I buy this $300K house and flip it, I'm safe. But at $800K, somehow it's riskier. And it's like, if you buy the right deal and you do the right work, there's a strike price for everything. But I think where I see people making the most money is probably $800K and up, because the people buying 300 and staying in that range are sucking all the margin out of 300, 400K houses. And the guys buried entry. We talked about this when I walked in. The buried entry is where the money's at.
Yeah.
Plus, I like the larger deals too, because believe it or not, our default and late payments are they're like non-existent in the larger loans.
Wow. So, I mean, based on that, I would imagine that those are more experienced people. Like, on average, you're probably not, as a new investor going in and getting like $1 million flip.
I mean, it depends. I feel like so many people have the real estate bug. I can't definitively tell you just because someone's doing a larger project that they're more experienced. They might be better capitalized. And that's why when they enter the space, they're going after the bigger deals, because they're going, well, there's return on investment, but let me tell you, there's also ROT, return on time. And they're not wanting to go do a $300K deal to take 3 months to make $27K.
Yeah.
So it's not necessarily that they're more experienced. They might just also be more better capitalized.
Sure. But I mean, so are you, so $1 million deal, they got to come in with, let's say 200,000, 20% down, but they've never done a flip. It's their first flip. So they're capitalized. Like, are you looking at that? Is that
sometimes
part of the equation?
I'm also looking at the deal. And if it's that big, I may look at liquidity. And if the liquidity is there and the deal's good, we're good.
And that's not like, because I mean, I've done a few flips, nothing crazy, but it's like, yeah, I mean, I remember the first flip I did, like, dude, I screwed up everything.
Sure.
I missed by a long shot.
But you didn't screw up intentionally. So imagine this, $1 million deal. Oh my God, first deal, which I got to tell you something. $1 million deal is like what 400K was like 8 years ago. It's not even that big, right?
Normal how.
So you screwed up is what you said. You didn't screw up intentionally. Yep. And you also had money behind it. So if somebody buys $1 million house, they put 200 grand down hypothetically, and they're going to increase the value, which they're going to put more money in. So we have 200 grand of the person's money. They're vested. They're not screwing up intentionally. Plus you have a good deal. Likely, even if you screw up, it's really you who's losing money, not us. So that's the benefit of being the lender, not a partner. You are in first loss position. You're taking the risk, not us. So remember, I want you to make money.
Yeah.
But I want my money back. So first loss position is what I call it, is that, yeah, you might have screwed up, but did the bank get all their money?
Yeah.
See, I'm not here to tell you to do a deal or not do a deal or to tell you what's a great deal. I'll tell you, hey, I think that's a bad deal. But my lending perspective lends from the standpoint of, am I covered up, down, and sideways?
Yeah. How is it with, maybe I misunderstood, did you say your partner on this fund?
Yep.
Okay. So how is it with, in terms of, let's say, your underwriting, like obviously you guys have a set of parameters.
Correct.
But if you wanted to, can you guys move outside of those? If you're just, like you said, if there's just like a no-brainer deal or something, or just somebody that you know and trust, they're good for it, they're experienced, you can go outside of those parameters.
The way I look at this is the straight answer and the easy, fast answer is yes. However, I don't want to make a habit of making our fund pick favorites or against the box. There's so much need for money that there's so many deals out there that, I have to protect my investors in our fund. Like my allegiance is to the investor, to the check writers before the borrowers.
And that's the same with the traditional banks. They just have much higher, because they have the shareholders and everybody else. They're like, if it doesn't go anywhere near the box, we're not going anywhere near it, right? So you're more lenient, I'm sure, than Chase Bank, but you're not going to bend so far out of the rules where it's too risky. It doesn't make sense to do it.
I mean, by nature, hard money is already, there is no box, right? There's some guidelines within it, but I guess I would say it's just a bigger box. Let's call it that, right? Banks are like, here's the box, fit in it or don't. That's it. Yeah. Whereas we're like, okay, hey, credit's shitty, but loan to value is good, or there's upside. Like I look at it, even though I'm not a partner in the deal or funding like a partner, I look at it as a partner from the standpoint of, if I got this back. I teach my sales guys this. When the calls come in, you have to ask yourself, okay, let's look at this deal. All right, I like this deal, but if I take this back, who am I going to sell it to? How fast I'm going to sell it, and how much I'm going to sell it for? And if those questions can't be definitively answered, you either have a risky deal or you should not do the deal. At least that's the way I operate from.
Kind of not shifting, but you said that it's been fairly recent since you kind of started on social media.
About a year, and I think we did June of last year, was it? Yeah, June of 23.
So I mean, that's fairly recent. So how has that helped you in building your personal brand like that? How has that helped your business grow?
It's insanity. The amount of people reaching out across all the platforms over a daily basis. I mean, that's how I met you, right? Yeah. Like the amount of people reaching out, looking for deals, looking for personal mentorship, sales training. I've had to hire a social media manager and then a second person for kind of the spillover of that.
Yeah.
When I first looked at it, or first kind of social came out, or I was first on it, I kind of thought it was weird, like it was too flashy or too much. But in reality, people should know who you are. Yeah. I mean, everyone is on there, right? Everyone's on social. It's like, hey, if you market on Google, it's the same as marketing on social, right? It's not the same. We have Google, but the thing is, everyone is on there.
Yeah. Well, and it's attached to you, a face so it's different than a brand, just, a name.
Well, I mean, you can obviously promote your brand through it, but yeah.
Sure, but still, it's you who's promoting it, so people can get to know you. Like, I like this guy or I don't like this guy, and move on or do some business with you. That's a question that I like to ask everybody that comes on here, because typically everybody that came on here came somehow through social media. They either have a big following or something, and just like same thing. That's how we met. Because that, it's like you said, I mean, earlier, like marketing before sales. And
every time.
And yeah, it's crazy how much it can blow your business up if you just put some effort into it.
Well, it's another thing too, like, I was telling you, like the marketing concept, like, maybe if I had one deal I was working on, I'd think about forcing it or have to think about forcing it. But if we're seeing tons of leads of sellers or motivated sellers or tons of people that need hard money, we don't
selective.
Yeah.
What is to go back on the lending side, what are you truly trying, like between the fees and the interest rate and all that stuff, like when you're turning this money, what's really the goal here? Like, is there a percentage?
What's the yield that we're trying to get?
Yeah.
Okay. I mean, again, ballpark 12 and 2 is kind of like where I'm trying to be, depending on the deal.
2% up front on the fees.
Yeah, not upfront, but at closing. Yeah, we don't charge any upfront fees.
I understand that. Okay, so
Yeah.
2 on the fees and then 12 on the yield.
Correct. Yeah.
Got it. Okay.
Ballpark. If it's a smaller deal and I don't really want it, I might charge more because I don't really want it. If we're doing some seconds, I don't necessarily want to make a habit of it, but I mean, geez, you're looking at a second from a bank loan and you're a qualified borrower and you're probably somewhere between 12 and 13%.
Mm-hmm.
So
well, it's also jumbo.
Okay. So, but you're a qualified borrower, right?
Yeah.
Okay. So we're doing seconds like in the 16s and 17s. And people are like, oh my God, that's insane. Well, go to the bank because if you can get it from the bank, get it. But the loan you can't get from the bank is already at 12 and 13.
Right.
So where do you think we're going to be on a second?
It's going to be higher, yeah.
You know what I mean? So it's just cost of money. It's the market, right?
So if you were on the investing side, not on the lending side, right, and you're going to use hard money, I guess let's take a step back. If you had the cash, would you rather do that or use someone else's money?
Every time someone else's money.
Okay, even though there's points and all that other stuff?
Yeah. Like I said, price is what you pay, value is what you get. Look, if you have X amount of dollars and you found this one deal, you don't have another deal, sure, pay cash. And because you don't want to pay interest, cool. So pay cash. You can always go back to a lender and get cash back out. We do a ton of cash outs. I believe there's 2 reasons why people use leverage. 1, they don't have the money or all the money. Or 2, they have tons of money, but they want the leverage so they can do the most amount of deals, right? So depending on where you're at in your deal flow, it's maybe not a bad idea to go pay cash for something and then, I found a second deal. Let me go get the cash against that to buy the second one.
And that's that. So that's kind of the Burr method, right? I'm sure you're.
No, that's not the Burr method. That's based on where you're at. Like, so Nicole, I'll call you when I'm done. Okay. You have X amount of dollars, like in lump sum or available to you, right? Directly. You find a deal. And it's a deal that you could pay cash for. You have enough in lump sum to pay cash. You pay cash, right? Because that's the one deal you have. Cool. No other deals come about. You're not looking at other deals. Pay cash. Don't have any cost of money. Awesome. What if you're the guy that's moving and shaking looking for multiple deals? Well, maybe then if you're like, hey, whatever, I'll pay cash for this deal. And then if I find another deal, I can just get a loan against the one I paid cash to buy the other one.
So I get that. That's what we're doing. I just don't. How do we do it to where we're not stuck putting 20% down over and over and over?
I mean, I don't get a gap funder, find a partner, find somebody else who's going to be that for you. Again, people ask me this all the time, and I say the same thing. Find a lender find a private investor who's willing to just fund you the whole thing, or fund you the 20%, or find a partner who's going to be like what we call a gap funder.
Right. I understand gap funding, but it's the same concept. You're stuck in there with that 20%, and that can only stretch so far.
Well, not on the private side, like you're saying.
Yeah.
Well, if you have someone who's going to, 100% of it.
Like on my deals, I have guys give me 100% all the time, but these are people I've got relationships with and like the deals are good and that's earned over time. I don't think, unless you just find the guy who doesn't know what he's doing, which they're out there, I don't think 100% is the norm, even though it's out there. Does that make sense?
Yeah, I wouldn't expect 100%. So the target, like my idea here with these flips or buy and holds is you get a good deal on it. You put 20% in or 10% in down, fix it up, whatever you need to do, and then refinance and pull all of that out. And then do it again.
Okay, so that's the Burr model. Okay,
right. That's what I was referring to.
Now that Burr model is going to be more from the standpoint of the bank taking you out, because the Burr model is not something you really want to do with hard money because the cost of capital is so much that it's going to kill your cash flow. So you would effectively, in this scenario, you buy the fix it up with hard money because that's generally what people would do. Fix it up. You pay 200 grand for it. You put 50 grand in. Now it's worth 347. Cool. Now you go to the bank and you pay off the 250. Now you have no money in the deal. Right? But there's 2 things this requires. It requires a good deal, right? That more importantly than anything, it requires a good deal because you need to be able to have the upside enough that whatever percentage the bank's going to take you out at, that
pulls all your money out.
Yes. And the other thing I was going to tell you was from the 100% or minimal down standpoint, like you have to understand lien position too, because if you got a hard money lender and he's like, hey, okay, I'll give you 85 or 90%, that's great. And you're going, well, can I find somebody else who's going to give me the second? Well, maybe. But now you're asking for, let's say, a much smaller amount of money, so it may not be worth it. They're also at extreme risk because they're now not only in second position, they're super high combined loan to value, and they're behind a hard money lender, which is suicide, because if you default, that interest rate goes way up, and now they're behind it, especially at a high leverage. Does that make sense? Kind of.
I believe it does.
So, I mean, again, I'm doing one right now. It was like the house was worth 900 grand. He owed 280 and we're giving him 100 grand for his pool business. That's like a second I would do, right? Not 92% from a second position. So really, I think if you're ever gonna get super high leverage, you're really gonna get it from a first position.
Right. And that's that hard money at the beginning
Yeah.
to fund that whole thing, but you have to find it. It comes down to the same thing. It comes down to a good deal. Like none of this stuff works without a good deal. It's
my whole point. That's why I said, hey, you can do this with no money and no credit, but you can't also have a shit deal. You know what I mean? So otherwise you're gambling. You're doing a deal because it sounds cool.
I guess for me, I've always been a volume guy, and anything like, we'll install 1,000 roofs this year. We'll do, that kind of stuff. Like for me, real estate doesn't seem, why can't I do 1,000 roofs? It's like,
sure.
Some kind of idea, a little bit different barrier to entry, and then getting your money all tied up in down payments. I mean, you'll run out.
Listen, if you're doing that many deals, you're naturally going to attract money, and you're naturally going to be at groups and seminars where people are there. Like, remember, there's the deal, there's the money, there's time, there's money, right? There are plenty of guys that can't do deals, don't want to do deals, but they have money. They would look at doing deals and cringe, but they have money and they get it. So it's the yin and the yang. Put yourself in the rooms, put yourself in the meetings and stuff where guys are the alternate to what you're doing, and there's the merge. Does that make sense? It's not going to fall from the sky.
Right.
But I think as you start to do that too, and people see a track record, you will attract money. Money has to move. Yep. It can't just sit there. So sure, maybe they could put it in the stock market. Maybe some guy doesn't like it, or it can go in money market and lose money from inflation. But money has to move. Find the deal. The money will come.
That's probably the best advice there, huh? Find the deal and the money comes.
That's it, dude. I got money. People come to me for money all the time.
See? Are you doing that deal, or maybe he gets a piece of it, but you're not really like running the deal. You're not making the lion's share of the deal, but you're passive. That was the point of that investment.
Yeah. It's just getting in the right groups, man.
Yeah.
And working like you said. I mean, there's so much money out there. It's stupid.
It's unlimited.
Do you go to a lot of those types of seminars and all that kind of stuff?
I tend to, in the past couple of years, have been more focused on barrier to entry seminars. I don't like going to free seminars. You want
good quality people.
I want to know you paid to be in that room, because that means you're serious. Yep. I want to know that, I've done so many seminars that I can tell you that there is a significant difference when you're in a room where people paid. And I don't mean $29, like
right.
1,000, 5,000, 20 and up.
Then you're dealing with people that are serious about doing this.
Listen, I swear to God, I've gone to so many high level seminars, and I always meet minimum at least one person that in time paid for that seminar back. Right. Oh, yeah. And it's like, and it may not be right away. And it's, the other thing is like we all have those friends and people we know, and they're like, I'm not going to that seminar, or they go to the seminar and they leave it and they're like, man, I went to that seminar for a day or two and I only learned one thing. I only learned two things. Well, if you think of success as long-term, it's one or two things consistently over time is actually what equals the result. Yep. You're just a negative person. You know what I mean? One or two things today, one thing next week. Like, it's not that hard. You just have to have a better attitude about it.
Well, I think a lot of people don't understand the value of these seminars.
Yeah.
Because the reality is most people will go and show up to these things, and then they'll leave and they won't do it. Nothing changes.
Right.
And then it's like, oh, it's a big joke. When in reality, it's not necessarily even what you learn. It's who you rub elbows with. And
more than anything.
And that's really, I didn't understand that either. And I've been to a couple seminars until really me and him started hanging out. And he's like, dude, we got to go to these things. I'm like, why? I don't waste my time dealing with a bunch of motivational speakers. I've been all, I don't need to hear that shit. And he's like, no, it's about the people. It's about the relationships. And that's when everything changed. When I started looking at seminars as a means to build good relationships with quality people that are on the same kind of pathway. That's where the value comes.
Agreed, completely. Also part of the reason why I place a lot of emphasis on barrier to entry at a seminar, but also I think there's the concept of a networking group and then a networking agenda group, meaning like, hey, come on down, let's meet a bunch of like-minded individuals. You hang out and they drink beer versus, hey, let's meet like-minded entrepreneurs. Day one, we're going to discuss this. We're going to go through this. We're going to discuss, and there's actually like a freaking agenda. Yeah. Does that make sense? I love the agenda one, right?
Are you in some now?
Oh yeah, absolutely. Do you know Boardroom? I'm in Boardroom. Ken? Yep. I'm in Speakeasy. I'm
Kent, Clothier?
That one, that's a great one.
He's next level.
I mean, there's like billionaires in that group, right? But like, I believe in those things big time.
Are you in B&I stuff?
Love BNI, not, it's that, well, you'll figure out what I'm saying.
Yeah,
it's not
low level.
No offense.
Yeah. Well, dude,
So
we blew right through an hour.
Is that how long? Holy
yeah, it's been a while, dude. But nah, we appreciate you coming out, dude.
Dude, thanks for having me, man.
This was good, dude. Learned a lot. Where can people find you?
So you can find me. We are redeveloping our site. It'll be mgicapital.com, which is not yet up. It should be in a couple weeks. In the interim, you can go to hmaz.com, which is hardmoneyarizona.com. And my cell phone number is 480-299-1434.
Social media, where you at? Where I found you.
Oh, man, it's Hard Money Michael, pretty much across all platforms.
Well, dude, this has been great. We appreciate you.
Yeah.
And, that's another episode of Real Estate AF.
Thank you. That was awesome, man.
Yeah.
Yeah. Appreciate you guys.